Hello and welcome back to All Things Money. I am your host, David Blain, and today we're talking about John Paulson, the hedge fund manager that made $15 billion in 2007. And we're going to tie that in with an article on J.P. Morgan. I was relaying the story of how John Paulson did this, kind of letting you know also that these type of trades are not accessible to the individual investor, and that the world of Wall Street sort of moves to its own drummer, and that these are very sophisticated trades. At the same time, the trades that he was making, and we read about his success. What you don't read about, now there are a few anecdotes in the book. Well, by the way, I'll give you the name of the book again. It's called The Greatest Trade Ever, the behind-the-scenes story of how John Paulson defied Wall Street and made financial history by Greg Zuckerman. And it's a great book if you want to understand how Wall Street really works. And so within the book, you see these other actors and different players, these hedge funds making these huge bets, and some of them were wrong. And they lost all their money. And they were right. They knew that housing was going to collapse, but they were too early or too late, and they didn't make any money. And so once again, the timing, not only do you have to have the right idea, you've got to have the timing, you've got to have access to the capital, you've got to have access to the sort of Wall Street machine to make these type of trades work. And I was joking in the first segment, people sitting out there saying, well, why can't my advisor do this? Or why can't David Blain, make 500% in 1 year? And that's why these are not things that, you have to have billions of dollars. You have to be in Wall Street, and you have to understand how the investment banking world sort of works. So anyway, in summer of 2007, the markets began to implode, and Paulson started making some money. And the other thing you see in this book is these things, these CDOs, insurance on CDOs, the pricing. It's not like you can, go to google.com and look up the price of insurance on a CDO. You've got to call up a broker, an institutional broker like Merrill Lynch or Deutsche Bank or the old Bear Stearns or Lehman Brothers, and they'd have to actually go around and they'd call people and they'd have to get bids. It's a very slow process on these type of things, and for the longest time, the bids would come back very high, and the reason is so Paulson had bought insurance on these CDOs, and if the CDOs dropped in value, which meaning Paulson's insurance bids were going up, it means that the investment bank on their books, because they own a lot of these CDO investments, they would have to write their asset down in order to give Paulson a higher quote. And so that would be very bad for their balance sheet and cause concern to the investors, other people that did business with them. And so for the longest time, Merrill Lynch and Bear Stearns and Deutsche Bank and all these investment firms on Wall Street, they kept giving these artificially high quotes. And Paulson and some of the other people that were making these trades, they just could not understand why these quotes were so bad. And they knew that these mortgages were imploding. They knew that the companies were in trouble, but the quotes were not representative of what was going on. So finally, things started really imploding, and Bear Stearns went under it, or actually Bear Stearns, got semi-bailed out by the Treasury and J.P. Morgan, and then Lehman Brothers went over. And so finally, Paulson was able to realize the majority of his gains. Just to put this in perspective, he made billions in 2008. Up until that point, one of the greatest trades of all time was George Soros' trade back in '92, where he bet against the British pound, and this trade dwarfed it. So it's a great book. It's a good read if you're looking for something. It's fast-paced. It has some elements of intrigue, but it really gives you the good feel for the inner workings of the way Wall Street works and the way that money and these hedge funds and things like that move money around. And it makes you realize that, if you're an individual investor with, less than several $100 million, I mean, there are people that had hundreds of millions of dollars that these brokers would not let trade in these instruments. That your best bet is some sort of longer term. Our advantage as a smaller investor is to take a different time frame. That you're not going to beat the Wall Street people on a shorter time frame. You're not going to beat them on basis of access to information. I mean, Paulson was able to look into these pools of mortgage, and they would scour the documents, and they could figure out who the people were in the mortgages and the bad loans and things like that. So that brings us to sort of full circle. I was reading this book already, and then I noticed this story on Sunday by Louise Story. It's called J.P. Morgan Accused of Breaking Its Duty to Clients. And one of the things that initially right away jumped out at me was the word duty. As an investment advisor, a fee-only advisor, we have what's called a fiduciary duty to our clients, meaning that we're legally required to put our clients' interest above our own. And I thought it was interesting that the author of this may not have even realized, but by putting duty in there, that is not a fiduciary duty to the clients. A broker-dealer, such as J.P. Morgan, the way they were operating with these funds, they had no fiduciary duty. Their duty is one of reasonableness and things like that, but it's not a fiduciary duty. And as I go through this, you'll see the big difference in that. That the essence of this story is that in 2007, J.P. Morgan, as the crisis was coming to a head, they were putting their clients into investments that were going under, and at the same time, they were loaning money to these same hedge funds, and they ended up actually making money where their clients were wiped out. And so there's a big lawsuit going on about that. But we'll continue with this after a short break. So for All Things Money, I'm your host, David Blain, and we'll listen to a few short messages from our sponsors.